Buying a car in America is often described as stressful, confusing, and expensive. Many customers walk into a dealership unsure of what the real price is, how financing works, or whether they're getting a fair deal. But why does the dealership system work the way it does? Why can't you simply buy a new car directly from the manufacturer? And who actually makes money in the process? Today, we're breaking down the real structure of car dealerships in the United States, how they operate, how they profit, why state laws protect them, and whether the traditional dealership model is slowly changing. Disclaimer: this video was generated with the assistance of artificial intelligence. Some details or interpretations may contain inaccuracies. Viewers are encouraged to verify information through official sources. Let's begin. Why dealerships exist? In the early 20th century, car manufacturers didn't have the infrastructure to sell vehicles nationwide. Instead of opening thousands of retail stores themselves, companies partnered with independent local businesses. This franchise model allowed manufacturers like Ford Motor Company and General Motors to expand rapidly across the country. Dealerships handled inventory, local marketing, service and repairs, financing assistance, and customer relationships. In exchange, they received the right to sell vehicles within a specific territory. Over time, this system became deeply embedded in U.S. law. Franchise laws and legal protection. Today, every U.S. state has franchise laws that protect dealerships. These laws generally prevent manufacturers from selling new vehicles directly to consumers. The original purpose was to protect small, local business owners from being undercut by large manufacturers. But critics argue that the laws now limit competition and keep prices higher than they might otherwise be. This legal structure is why traditional automakers typically cannot bypass dealerships, even if they want to. How dealerships actually make money. Many buyers assume dealerships make most of their money from selling new cars. In reality, new vehicle margins are often relatively thin. Profit usually comes from financing and loan markups, extended warranties, service contracts, add-ons and accessories, used car sales, and service departments. The service department in particular is often the most stable and profitable part of the business. This is one reason dealerships value long-term customer relationships. The financing game. When you finance a vehicle at a dealership, the dealer often acts as a middleman between you and a lender. The lender may approve a loan at a certain interest rate, but the dealership can legally mark that rate up within limits. That difference becomes profit for the dealership. This practice is not illegal, but it's one reason why negotiation can feel complicated. Understanding loan terms, APR, and total cost over time is essential. The psychology of the showroom. Dealerships are carefully designed sales environments. Sales tactics often include focusing on monthly payment instead of total price, trade-in negotiation complexity, time-based pressure, and add-on bundling. These techniques are standard retail strategies, but because vehicles are high-cost purchases, the impact feels larger. This contributes to the perception that dealerships are direct-to-consumer disruption. In recent years, companies like Tesla Inc. have challenged the traditional model. Tesla sells vehicles directly to consumers through company-owned stores and online ordering. However, in some states, Tesla has faced legal battles due to dealership franchise laws. Other automakers are experimenting with hybrid models, combining online ordering with dealership delivery. The traditional system is evolving, but it has not disappeared. Are dealerships overpriced? The answer is complex. Dealerships provide local service infrastructure, warranty repairs, trade-in convenience, inventory access, and regulatory compliance. These services come with operating costs, including property, staff, insurance, and inventory financing. However, critics argue that mandatory dealership layers reduce pricing transparency. Supporters argue that dealerships create competition between local sellers, which can lower prices. Both arguments have merit. The shift toward online sales. Consumer behavior is changing. Many buyers now research pricing online, secure financing before visiting, compare inventory nationwide, and negotiate remotely. Some dealerships now offer fully online purchasing processes. The COVID-19 pandemic accelerated this digital transformation significantly. However, most transactions in the U.S. still involve a dealership at some stage. The future of the dealership model. Several factors will shape the future. Electric vehicles, which require less routine maintenance, digital retail platforms, changing consumer expectations, potential legal reforms, and manufacturer pressure for more control. Some analysts predict dealerships will shrink in number but grow in sophistication. Others believe the franchise system will remain largely intact due to strong legal protections and political influence. For now, the dealership remains the dominant retail model in the American auto industry. Conclusion. The truth about car dealerships in America isn't simple. They're not purely villains, nor are they purely consumer advocates. They're businesses operating within a legal framework that has existed for over a century. They provide convenience, infrastructure, and service. But they also operate within a system that can create pricing confusion and negotiation pressure. Understanding how the system works is the best tool any buyer can have, because in the end, knowledge reduces friction, and informed buyers make better decisions.